Welcome to the video. Today we will unpack a common money dilemma, whether to pay off low-interest consumer debt or to keep maximum cash for a near-term home down payment. To make this practical, we will guide you through the math, the liquidity reality, the psychological angle, and a simple decision framework. We will also include interactive quizzes to check your understanding. Let's start by previewing what's ahead, and then move into the core trade-off. First, we will establish the context and define the core trade-off. Next, we will examine the math versus the actual goal. Then, we will apply the financial flip test to clarify your decision. After that, we will share expert guidance and a time horizon playbook. We will then explore a cash bucket approach and walk through a concise case study. Finally, we will summarize key takeaways and action steps before the closing. Here is the situation. You are carrying a low-interest consumer loan, for example a car loan, under 4%. Simultaneously, you are saving aggressively for a down payment on a home. The question is whether to pay off the debt or to preserve maximum cash. As we transition to the trade-off, keep in mind that timing, liquidity, and your primary goal all influence the correct move. The core trade-off is about choosing between eliminating a low-rate loan or preserving cash for a near-term purchase. If your home purchase is within the next 12 months, prioritizing liquidity tends to be advantageous because you need flexibility to move quickly. Conversely, if your timeline is longer, you can compare your loan's interest rate to safe returns such as high-yield savings or certificates of deposit. When the loan rate is higher than what you can earn risk-free, extra payments toward debt often make sense. However, when the difference is negligible, access to cash frequently outweighs the tiny interest arbitrage. Now that we have the framework, let's compare the two paths side by side. On the left, accelerating debt payoff gives you a guaranteed return equal to the loan's annual percentage rate and simplifies future cash flow. The trade-off is reduced liquidity when you need it most. On the right, prioritizing cash lets you seize a buying opportunity and reduce the risk of coming up short at closing, but it means carrying the low-rate debt a bit longer. With the trade-offs clear, we will examine the math versus the actual goal. Mathematically, paying off a 3.9% loan is analogous to earning a risk-free 3.9% return. If your high-yield savings or certificate of deposit earns around 4%, the spread is minimal. Importantly, the difference is often overshadowed by liquidity needs. When your purchase timeline is within the next year, the ability to write a check and close quickly is more impactful than a small interest advantage. With that in mind, let's apply a simple test that often clarifies the decision. Here is the financial flip test. First, imagine the debt is already paid off. Next, ask yourself whether you would borrow $10,000 at 4% solely to bolster your down payment savings. If your answer is no, because borrowing for the purpose of savings feels irrational, that suggests eliminating the existing debt could deliver psychological relief and simpler finances. However, if your answer is yes because maximizing cash for closing is vital, that indicates liquidity is the priority and maintaining minimum payments for now is reasonable. Before revealing guidance, let's test your understanding with a quick question. Question: if your home purchase is 6 to 9 months away and your car loan is 3.9%, which factor should you likely prioritize? Options are: A. Maximizing liquidity for the down payment. B. Aggressively paying off the car loan for a guaranteed 3.9% return. C. Stopping all savings to pay only the debt. Or D. Borrowing more to invest in riskier assets. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is A. Maximizing liquidity for the down payment. With a near-term purchase, flexibility and the ability to close are typically more valuable than a small interest advantage. Now that we have reinforced the priority, let's zoom out into a visual decision map. This mind map starts with the central theme of liquidity versus low-rate debt. One branch covers timeline, spanning 0 to 6 months, 6 to 12 months, 12 to 24 months, and beyond 24 months, because timing largely drives the decision. Another branch addresses the math, comparing the loan annual percentage rate to safe yields, highlighting that the spread is often negligible. A third branch explores psychology, including simplicity, stress reduction, and the flip test. Under each timeline, guidance points indicate when to prioritize cash and when it may be reasonable to accelerate debt payoff. With the decision map in mind, Let's move to practical expert guidance. Experts typically advise that when a major purchase is close, you should maintain strong cash reserves, continue regular, on-schedule payments on the low-rate debt, and keep your down payment funds in high-yield, liquid accounts. Once you successfully close on the home, you can redirect any surplus cash flow to accelerate the remaining debt payoff. Next, to make this even more actionable, we will share a time horizon playbook. This table provides a general playbook by time horizon. From 0 to 6 months, prioritize liquidity and make minimum payments. Use high-yield savings for cash. From 6 to 12 months, still focus on liquidity, but consider a small extra payment only if it does not compromise readiness. You may use a short certificate of deposit ladder. From 12 to 24 months, balance liquidity with payoff and add extra payments if the loan rate exceeds safe returns. A mix of savings and certificates can be appropriate. Beyond 24 months, optimize based on interest rates and potential returns, and consider faster payoff if warranted. A practical structure is to divide your cash into buckets. First, maintain a dedicated down payment fund that is highly liquid and low risk. Second, keep an emergency fund as a separate buffer so that an unexpected expense does not derail your plan. Third, ensure minimum debt payments are made on time to protect your credit. Finally, consider optional extra paydown only when it does not undermine your liquidity for the upcoming purchase. Now that we have the structure, let's test it with a concise case study. Consider a $10,000 car loan at 3.9% annual percentage rate. You plan to buy a home in 9 months, and your high-yield savings earns roughly 4 to 4.5%. Option A is to pay off the car now, which reduces monthly obligations but lowers your down payment cash cushion. Option B is to maintain minimum payments, preserve cash, and maximize your ability to move quickly during house hunting. Apply the flip test. If the loan were already gone, would you borrow $10,000 at 4% solely to expand your down payment? If your answer is no, payoff may provide psychological relief. If your answer is yes, keeping cash likely aligns with your priority. With that in mind, let's check your understanding. Question: in the case study, which choice best supports a home purchase in 9 months with minimal risk of missing the closing table? Options are: A. Pay off the car loan now. B. Keep cash and continue minimum payments. C. Stop saving and invest down payment funds in volatile assets. Or D. Borrow more to increase the down payment immediately. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is B. With a 9-month timeline, preserving liquidity is the priority so that you can close when the right home appears. After the purchase, you can redirect cash flow to eliminate the remaining low-rate debt efficiently. Now, before we wrap up, let's cement the key takeaways. The key takeaways are as follows. First, when your purchase timeline is under 12 months, liquidity tends to be more valuable than small rate differences. Second, the flip test is a fast way to clarify your preference. Third, continue making minimum payments on low-rate debt until the purchase is complete. Finally, after you close, allocate extra cash to pay down the remaining debt aggressively. With the highlights clear, let's summarize next steps. To wrap up, first define your time horizon and the priority of the home purchase. Next, compare the numbers and then apply the flip test. If closing is within 12 months, keep your funds liquid. After your goal is accomplished, accelerate debt payoff with renewed focus. Before we close the video, let's include an important disclaimer. Disclaimer: this content is educational and does not constitute financial advice. Your circumstances are unique, and you should consult a qualified professional before making any financial decisions. Additionally, interest rates, yields, and market conditions change over time, so verify current data and consider your personal risk tolerance and goals before acting. Now, to close, here is a quick call to action. Thank you for watching. If you found this helpful, please like the video, share it with someone who is weighing debt versus down payment, and subscribe for more clear, actionable finance content. Finally, tell us in the comments whether you would prioritize liquidity or payoff in your situation and why.